Welcome to the Broken Pie Chart Podcast, episode 319. I'm your host, Derek Moore. With me, returning, is Mike Puck, also from Zega Investments. Mike, what's going on? Anything today? Anything new in the markets?
Busy day in the markets, Derek. That's for sure.
All right. You and I were talking earlier, and I was saying I'm a little older, been in the markets more years. I have more of these under my belt. But I was trying to reflect. These downturns, and just to sort of level set everybody where we are, not like, anybody doesn't know where the markets have been. Since the February 19th high, the S&P index, S&P 500 index, is now down 17.26 off the high. It was up from the end of the year, so it's not down 17% year to date. And it sort of takes us back to where we were in the markets around August 5th. So imagine you turn your computer off and you saw your account values or whatever it was, the S&P back then. We're sort of back there. The NDX, the Nasdaq 100, down. It's in bear market territory. It's down 21.43%. Russell 2000 minus 19.76. The Mag 7 roughly down minus 25. The one thing, and it just started to break a little bit. The spread started wide, and we'll talk about it later, Mike, is high yield. High yield is really only down about 3.3, 3.4%. But it's like, this reminds me of March of 2020. It reminds me of 2008, 2009. Not exactly that. That was crazy. We were down 57% at one point. Was it August of 1998, the Asian contagion, August of 2015, Brexit. Well, Brexit wasn't that bad. So I don't know. Every time it's different, and every time the urgency and people's fears are the same. But this happens. But 10% in 2 days, that's significant, right?
Yeah. So we talk about this a lot with clients and just, in conferences or webinars that we do. 10% pullbacks are normal, right? They happen consistently. Maybe not every year, but almost every other year there's a 10% pullback. A lot of 5% pullbacks happen, and a lot of 3% pullbacks happen. But the what makes this so shocking is that it's 10% in 2 days.
Sure.
Very similar to when interest rates were hiked in 2022, right? The first 75 basis point interest rate hike. The market dropped, I think it was about 10% in 3 days. So a little similar here with 2 days. I guess coming down a little hotter than 2022. But I think, Derek, people are nervous. They're not sure what to think. They're not sure what's next. Was this necessary? Was it needed? What are your thoughts here, or what are the questions you're getting at this point around, hey, what's going on? And was this necessary?
Well, the Trump administration thinks so. And they believe that you have to try and equalize trade a little bit. You have to take a look if one country has a tariff or has restrictive, barriers to entering the market. This is the time to do it. I'll be honest, Mike, I didn't dig into I saw the formula floating around, and it gets into I'm not even going to go into this too much, but like the elasticity of price and trade. And let me explain what elasticity means in economics. Prices are either inelastic or elastic, meaning let's imagine that gas prices went really, really high. Maybe you still have to get to work, and your substitute is to take the bus, take an Uber. If you can take a train, I don't know. But in general, the usage of gasoline doesn't change as much. But imagine for a second that French fries were now $100 a fry. Well, everyone's not going to do French fries. So some prices are more elastic than others, inelastic. There's this formula where they say if you bring the tariffs to a certain rate and you look at the trade imbalance, that based upon elasticity of trade, and it's kind of a function. I'm just saying this is an economic theory, that you can theoretically balance the trade, and you do that with tariffs. Look, you could make a case that the delivery here hasn't been great, but I'll be honest. I think, Trump has been very clear, and everyone who talks from his administration has been very clear that they were going to do this. And I think the calculus for the markets and the calculus for maybe other countries has been he always negotiates hard. He always sets the bar really high. He says crazy stuff. He says, we're going to do 100% tariff, whatever it is. And then eventually he backs down. And I think they said, well, we know he's going to do that, so we're going to play hardball. I'm sort of simplifying this. And then so he just did it. And he says, well, it's a little bit of game theory. He's creating a credible threat. Maybe it wasn't credible enough, and he actually did the thing he said he was going to do. In some ways, I would say the market shouldn't be surprised because he did exactly what he was going to do. Do I think these tariffs are going to be in place for the next 6 months, a year? I'll let you know in a year. I don't think it's the end game, though. But maybe there was a miscalculation, and this is all a repricing. That's one theory, Mike.
Right. Yeah. Yeah. I think that's a big question that people have right now is, are these tariffs as large as, they talked about on the Liberation Day, right? Liberation Day, April 2nd. When Trump had that big conference, are these tariffs as big as people, or at least as they projected and on the, that big, cardboard cutout that they have, right? I think what you're saying and what we've kind of researched here is that these tariffs may not have just been in tariffs alone, right? They talked about improper currency manipulation, right? With some of the countries that have affected the United States, improper trade that have been done between the U.S. and certain countries. And I think from there, they came up with this number that they tried to say, hey, look, here are the tariff numbers, right? Here's the tariffs we believe, or the advantages you've taken of the United States compared to your country. And so they came up with these tariff numbers, right, of how they're going to implement them. I think there's, like you said, are these going to be on for 6 months? Are these going to be on for a year? We'll let you know, then. But that created a lot of uncertainty in the market this week. What's happening, right? Right, exactly. So what's happening, right? All this uncertainty of the tariffs that Trump's putting in place. How are these countries going to react, right? That's the other side of things. All right, how's Brazil going to react? How's India going to react? China. I saw Cambodia. I think Trump already tweeted or sent a truth message about it today saying, hey, that he's already spoke with them and they think they're going to come to some type of agreement, at least in the future, not anytime soon. But so the second part of the uncertainty here is what are the countries going to do? That's creating a lot of chaos in the market. So what's happening here, Derek? What's going on with the S&P, the Nasdaq, small cap market? What's spooking everybody?
Well, I'll give you an example, Mike. If you're an analyst right now and you're trying to do bottom up or top down earnings and you're trying to say, okay, I'm going to look at all the companies in the S&P and I'm going to come to an estimated over the next forward 12 months, what's my per share number on the S&P? Well, I'll tell you, it's only gone down so far from 271 a share to 269.88 a share. They look at the sales. The sales have come down from 1977 a share to 1973 a share. And I don't have my calculator handy, but when I did it the other day, it's like assuming a 13.7% margin. You and I were probably on the podcast in February. I believe we've done a couple this year, but when we talked, I remember the market had a forward you know what? That was our, we did a little webinar for advisors. That's what we did. Yeah. It was 23.3 times forward EPS, forward 12 month. Do you know what it is right now? It's 19.17. We've gone from a 23.3 multiple, forward multiple, down to a 19.17 multiple. So, but to get to your original question, if you're an analyst and you have all this uncertainty, how do you really put out a forecast? Like, how do you even know what companies' earnings are going to be? And if the tariffs are going to be on, if they're going to be off, that's the big thing. The market doesn't the market's never certain of anything, but it thinks it's certain at different points. It doesn't think it's certain about anything right now. So I always come back to earnings. And if you believe the earnings and I don't have any reason to doubt the analyst, 269.88, is that the number? Barclays says it's 261, I think. Do those get pulled down? Probably they get pulled down. But the market is selling off is getting cheaper. So I think that's part of it. You mentioned something to me last night. The other part of it is, I think you said the tariffs are exempt on, is it some medical, some pharma stuff,
Yeah.
and semiconductors. I guess
Correct. Yeah. So pharma, some energy materials, and semiconductors, tariffs are exempt on those products for now. It's under a very specific rule called 231, which if they are going to implement those tariffs, it could take 6 to 9 months to do that. So those have a little bit of a runway of not being taxed at this point.
I guess the problem too is, so you'd say, well, naturally, why don't I just go buy a bunch of semiconductors? I guess the problem is, though, the companies that buy those products might have their capex affected. I mean, that's sort of the unknown. And then, I mean, sometimes when the market's down, I mean, except for maybe some of the insurance companies like United Healthcare was up yesterday. It's up really well yesterday, really good. But I think it goes back to that uncertainty. It's I still think, though, should I even get into this? Sure, I'll do it. There's different views on the political spectrum. And what's really fascinating is, and we've seen this in the sentiment surveys, we've seen it in the inflation surveys, the University of Michigan. Remember, it was Democrats were very gung-ho on the economy, Republicans very sour on the economy. When Biden was in office, it just flipped when Trump comes into office. And I think right now, there's it's not half the country, because I think there's a big, wide swath in the middle. But at the edges, there's some people who say, we could be going into a Great Depression. And then on the other side, they're saying, look, we needed to do this. This is a chance for a reset. And I'll tell you one thing. I mean, if you wanted to get the 10-year down, you wanted to get mortgage rates down, I mean, I guess this is one way to do it. I mean, it's not going to get style points for doing it this way, but I mean, right? If you're buying a house, maybe mortgage rates come down.
Maybe mortgage rates come down. Yeah. So, the market was declining here into February, right? Let's not forget that, right? February was not a positive month. So, I think there was a lot of buildup to this. And then, let's talk about this though. Everybody anticipated this, right? And you hear this a lot around, well, it's baked in, right? The analysts are baking this into the market, or, it's already been priced in, or, the old saying that you buy on the rumor and sell on the news, right? So the rumors were out there that tariffs were going to happen. It was kind of baked in, as the analysts like to say, right? We were predicting some type of tariff, program, and then some type of, response from these other countries. And so why was it so abrupt this week, though? Why I get the market was declining, but why such the big decrease over the past 2 days?
I don't think when we say it was baked in, what was baked in was Trump is going to threaten the tariffs. If he does it, it's going to be much less. I looked at, who's the Apple analyst? Is it Ives? See the big Apple? It's slipping my mind. I think he put out a tweet. He said this was beyond the worst case that was expected. Just from the size of the tariffs. And then, the other thing is, we had the escalation. China said, no, we're going to do reciprocal tariffs. So at some point, do we hike more on them? They hike more. At some point, it's either somebody blinks or somebody doesn't blink. But Mike, I think that's what it is. I go back to, I don't think people really believed what the messaging was from the administration. I think they were pretty clear that they said they were going to do this. It was not baked in. And it just wasn't,
Sure.
This bill, Mike, I mean, you're talking to advisors all day. I mean, one of the primary things we do is we're a sub-advisor. We manage strategies for other advisors and their clients. And we also have our own wealth clients. Like, you're talking to them all day. And I know that it seemed like today fear was definitely in the market. Like yet the day before, okay, here's an interesting point. When the market first got down to 10% lower, I actually think there was more fear then. Then the markets recovered. Yesterday, not as much. Today, I think there was real fear that was coming in. I mean, you're talking to advisors all day and people like,
Yeah.
what are you hearing?
Yeah, so it's interesting. Yesterday, the first big down day. I mean, it was business as usual. I would say the phones were rather quiet, to be honest. Few strategy questions here or there, some positioning. But today was much different, right? Especially towards the end of the day, towards the afternoon. As people kind of caught the news cycle, or finally it was probably on every TV in every airport in America about what was going on with the market and the uncertainty. So today was, I would say, it was a lot busier, a lot of questions around what's going on and how to manage through this scenario. You mentioned, is this the right time for the tariffs earlier? That's some of the conversations I've had a lot, right? Is what's the why behind this, and why would the administration do that? And I think from what I've researched so far is, if you're, Trump and you believe that the entire global trading system needs to be restructured and reorganized, this is a way to do it. Right. So we get a lot of the questions of why. Well, so there's your why, right there. That's what the administration thinks. They think the entire global structure of trading between all the different countries in the United States needs to be reconfigured. So there's your why. So I think a lot of people need to get past the why of, okay, why is this happening? Well, there's the why, right? Okay, so now what do we do? I think a lot of the stuff that we do here at Zega really is around quality and not trying to pick something specific, like quality index, like the S&P 500, right? So that's been a big question around how do we manage through this. And I think quality and diversification are both really good things to look at when you have this much volatility in the market. And so those are the conversations we're having with advisors is, make sure you're in a quality strategy with a good index, right? Or, not risking or not jumping out in emerging markets, or, betting on China right now or India or certain countries, right? So a lot of these conversations are around quality and diversification.
I mean, one of the primary things we do is we hedge. And I think for those of you who are listening and are also happen to be clients or clients of advisors, we've had a couple questions today. I've got hedges on, but maybe the account's still down. A lot of people were giving up gains. We don't hedge from absolute $1. That would be too expensive. A lot of the hedges we put on were really tight, and they're good. But what you're seeing is, let's say you have hedges on and the market runs up higher. We're not rolling those hedges right under. It's not like a trailing hedge. That would be too expensive. In fact, sometimes even when the market's going up, people are saying, "Oh, why am I hedging again? Why am I giving up some of the upside?" But I think for a lot of people that we talk to, it's like, you're already hedged, like you're already managing your risk. And then for some of our other strategies that are more volatile and there's more risk in there, and every client's different, and every advisor and their clients are different, but they're already managing the risk because they only put a certain amount in those sort of satellite strategies. So it's kind of, you would put out a piece, Mike, and I think you had sent it out to your list of advisors you deal with, and it's what would you say? You're
Oh
probably glad
yeah.
you're hedged,
Well,
right? Something like that.
yeah, if you are on our email list, you did get a pretty good email this week around, or I think it was the Friday last week around hedging, and actually, I think we got pretty good feedback on it. But the title of it is, let's see, it said, "How do you feel about the hedges you added to your portfolio?" And it said, "Wait, you didn't hedge?" Question mark. So, yeah, we actually, good timing on that email, but we did send an email about a lot of our strategies and what we do around hedging. And I will say this: a lot of the advisors or advisor clients that we work with, um, the hedges have started to kick in some places. And so if you are hedging your portfolio, this is what you've been hedging for, right? If you're thinking about that down move in the market, hedging with options or hedging with, a different part of your portfolio, like diversification, this is all why you do it, right? This is why you look at those different areas of the market, or you look at hedging to the downside, because the markets don't always go up, right? I think we got a little complacent coming into last year. And I think I mentioned this, right? I had the feeling that my taxi driver was giving me stock tips, right? So that's an old saying from New York City is, when you land in New York and you get in a cab and your cab driver starts telling you what stocks to buy, that's usually a big red flag to get out of the market, right? Because it's just overbought. Everybody's buying because they just think it's easy to make money. I very much felt like that at the end of last year and into this year, where, my taxi drivers or my Uber drivers now were giving me stock tips. So maybe we got a little inflated, and hedging, it was really a good time to hedge over the past few months.
Can I tell you, at March of 2000, some people have heard me tell this story before. I'll make it a quick one. March of 2000, Mike, I'm going to my mailbox. We had one of those, lived in a gated community, and then we have a row of mailboxes. You just walk over, and I see the mailman there, and he hands me my mail. I'm like, "Oh, did you do that one?" He just hands it to me. I'd seen it before, and he sees I have a Schwab statement, and he says, "Oh, you're an investor." I said, "Well, I'm in the business. I run a trading team." He goes, "Oh yeah, this is my last week. I'm going to retire and be a day trader." Literally the high of the market in March of 2000. Like the Nasdaq went down 70%, probably from within days of that conversation. So yeah, you're not wrong, Mike. The other thing you mentioned too was the market really forecasting this? And one of the things that you can look at is something like the implied volatility in options. Like the options are pricing in the expected moves, and they're expecting, a stock that's going to move a lot more. The options will be more costly. Look at S&P options. If traders or the people who price options, the street believes that there's going to be more movement or more volatility in the market, it's going to cost more to buy options. Why? Well, Mike, you're in Miami. If there's a hurricane off the coast and you call your insurance company, "Hey, I'm thinking about getting hurricane insurance." Yeah, good luck. Here, step into my office.
Right.
Let me give you some numbers here, Mike. On April 2nd, let me see, the VIX closed at 2154. Is the VIX the right thing to use for this? Not necessarily. I'd want to do it on the options, but it's good enough proxy and for you home gamers. It closed at 21.45. So a 21.45, you say, divided by 15.875, which is the square root of 252. And basically that's pricing in about, 1.35% expected one standard deviation move. So what happens? Well, that was Wednesday? Thursday, markets were down. What were they, over 4%?
Yeah.
5%? Yeah. So clearly, normally implied volatility in a normal market during normal times, implied volatility is higher than what winds up being realized. And that's called historical volatility versus implied volatility. And then you say, okay, well, the VIX closes at a little bit above 30, right around 30. So you say the VIX at 30 divided by 15.875, you'd say, okay, a one standard deviation move is about I'll round it, 1.9%. Today, what happens? 5%. Now, today, the VIX closes at 45.31. And what that's saying is now, if we think 45 divided by 15.875, a one standard deviation move, the bell curve, 68% of the time, expecting 2.83%. I bring this up because this reminds me, I'm not saying we're going to have a March 2020. What I'm saying is that that's a period when you go back and you look at the options markets, and volatility, implied volatility, what the market was pricing in for expected moves, wasn't high enough. Because I don't know if you remember that, you had 10% moves and it was really only pricing in like 5 or 6%, you know?
Right.
So I I think that's part of it. I think it was we talked about the narrative and the news and but specific to really our world, the VIX vis-a-vis, implied volatility on options, it wasn't pricing volatility high enough for what wound up happening. And I think that's kind of you don't see that often. And a 45 VIX right now, that's pretty high. Sometimes though, you say you kind of needed a really high spike like this. Like there's a case, Mike. Okay, let me throw it to you. There's a case to say this is what the market needed to form a bottom. And I'm not saying this is going to happen, but you shake out the weak hands, you get an absolute surge in volatility, you get a really bad day on Wall Street. People panic, and that's sort of the bottom. It shakes out the weak hands. Like there's a case for that, Mike.
Right. There's a case here for that. Yeah. So that's a good kind of segue into the unemployment numbers today, right? So, 4.2% non-farm payrolls in March increased 228,000 for the month, up and revised from 117,000 in February. So decent unemployment numbers. So let's talk about the economy, right? Economy overall versus the market. I don't think there's any data right now pointing to a weak economy that we're currently in, or a weakening economy. I mean, unemployment's still low. Wage growth still seems pretty solid. So is this like you were talking about, you don't know if there's a case for the bottom here. Maybe it's today, maybe it's next week, maybe it's a year from now, like you always say, we'll let you know in a year.
Yeah.
But after these pullbacks do happen, usually markets recover pretty rapidly, and well, maybe not always rapidly, but usually at a good pace, and they can be very strong recoveries. So unemployment looks good, economy looks okay. So what are we thinking overall, right? Is just a short-term dip?
Well, I'm glad you brought up the unemployment number because last month it was 4.1, this month 4.2, but it's actually much more of a narrow change than you think. And the reason is last month 4.1 was rounded. It was actually 4.139%. This was 4.2 rounded, but it was actually 4.152. So the difference there is very narrow. And what you saw is I think over 200,000 jobs got added. But what happened is the size of the labor force rose, and it's just math. Remember, unemployment's calculated by all of the people in the quote unquote labor force, and of the people in the labor force, how many are working, how many are unemployed. The unemployed means you got a survey, you got called, and they said, do you have a job right now? Yeah, I do. Great. You're employed. Hang up. Call the next person. Do you have a job right now? No, I don't. Are you looking? No, I'm good. I'm good. Okay. You're not in the labor force. You're not unemployed. Hang up. You get the next person. Do you have a job? No. Okay. Are you looking within the last couple of weeks? Oh, yeah, I'm looking right now. In fact, I'm going to an interview today. Great. You're in the labor force, but you are unemployed. So there's just some math here by the size of the labor force that rose, even though we added 200,000 jobs. So this goes back to, no, employment's not showing an issue. It's really not. And we saw that with the ADP numbers as well. Now, Mike, you've seen the Atlanta Fed GDP and the forecast. I think right now it's what, minus 2.8% is estimated Q1 GDP. I will tell you, and that's by the Atlanta Fed, that's a nowcast. Every bit of data that comes in, they're changing, they're adjusting things. But most of that, I believe, is because everyone front ran the tariffs and they imported a bunch of stuff. And GDP is net imports and exports. It's, imports minus exports. So if that's negative, if you take away and by the way, I'm not a big fan of, it is what it is. But, if we get a print of minus 2.8%, that would be a headline. I agree though, Mike. It's too soon to tell on anything on the economy. It really is.
Yeah. And so just to unpack that a little more about what companies were doing, right? So a lot of companies were front running their product, right? In ahead of the tariffs coming out. So
they wouldn't have to pay the tariff, right?
yeah, correct. Yeah, I did read through that. So yeah, so a good example, right, is if you sell widgets, right? Maybe you stock up on your widgets, knowing that the tariffs are coming. Now that's harder for clothing companies and things like that, because that styles, right? Clothing or furniture goes in and out of style, so those change. So some companies were able to take advantage of stockpiling inventory, others not so much because of just industry changes. But reading through some of the headlines here, I mean, this is Muhammad Al-Arian from Allianz. He's the chief economic officer over there, and he was saying, I don't think a U.S. recession is inevitable based on the structure of today. It says, but the risk is getting higher, and he's a little bit uncomfortable. So I think you're going to get a lot of the talking heads, right? You're going to get a lot of mixed comments out there of, well, we're cautiously optimistic, or we're watching closely, but we're somewhat concerned, right? I think that's going to be you're going to get a lot of headlines like that, which don't make people feel comfortable. But I still think deeper in this article, and I still think overall, when you're reading through fundamentals and overall economy, we're in a very strong place currently, right? So I know this is a shock to the system at this point, but the economy overall is strong. We just told you unemployment numbers are low. Companies were preparing for this over the past few months, right? So we're in a strong position. We don't know what's going to happen, but I'd say as strong as we can be for what we're dealing with.
I'll give you the bear case on that. And I don't disagree with what you said, Mike. The bear case is companies are going to stop doing projects. They're going to stop spending money. They're going to hold off on things. They're going to hold off on hiring. The bear case continues that if let's say the tariffs are in place and, unemployment is one of the last things to go. There's this kind of theory that it's like housing, was it Cantrell he comes in with hope, housing, orders, profits, and employment. And employment's like the last thing. You see unemployment really shoot up just as the recession's here. The bear case is there's going to be a slowdown in spending by corporations, by companies who will stop hiring. You will see demand for products to go down if, in fact, the tariffs are inflationary. And there's actually sort of compelling arguments on one way or another. I mean, one is if it tamps down demand, then in theory, and then the dollar too. And we should talk about the dollar, Mike, too, because the dollar has weakened. And that actually makes our stuff that we export cheaper to the other countries. And it was the reverse that I was saying earlier when the dollar was strong, and it would sort of mute the purchasing power to buy things from China. But have you seen the dollar recently? Have you watched that?
I have not watched much of the dollar. I have seen I have seen the reversal that has happened, right? Because there was a lot, I watch the Brazil real frequently just because my wife is from there. So whenever we go back, right, we look at the dollar versus the real, and the dollar had gotten significantly stronger than the real for a very long period of time. There was a lot of talk in the beginning of the year around the U.S. dollar getting stronger, but it's actually reversed and been weaker.
It's down 7 point. Well, it reversed. It bumped a little bit today, but yesterday at the low it was down 7.17% from the high, which is right around 110. Around 102. That does help exports. So, all right. So here's another case. What if this is the grand plan by the administration, the Trump administration, to let's get mortgage rates down, let's weaken the dollar, let's make oil and hence gasoline and things like that cheaper. I mean, that's one theory. Like, you don't get style points. I mean, if this is what you need to get rates down. All right. So actually, I was going to go to rates. So I took myself off track. Do you know what the number of cuts that they're forecasted in by the Fed Fund futures right now? Do you want to take a guess?
Yeah, I think it's 3.
It's 4.
It's 4. It's all the way up to 4.
By
Wow.
December 25, it's 4. So the Fed funds would go from 4.33, the effective rate, all the way down to about 3.30. So that's
So all
different.
those people with those low mortgages may have an opportunity to lock in another low mortgage.
Well, that's the thing. I mean, the spread between the 10-year and the 30-year mortgage is still wider than historically.
Yeah.
Usually it's about 1.7. It's been higher than that. But, you know, historically, if you take 3.3 plus 1.7, you'd say you should get to 5%. I don't
Yeah,
know if we're going to 2.5, but you know.
right. Yeah. Well, and there's been a lot of questions if people are ever going to get those rates again. And I think no, right? I don't think you'll ever be able to lock in a 2% mortgage, but you never know.
But so what does the Fed do? I guess that's another question, Mike. Does the Fed come in? I don't think there's any emergency action on the horizon, but next meeting is May 7th. So it's still, it feels like a lifetime away, you know, but, you know, 3 days feel like a year sometimes in the markets. But I mean, there's about a 40% chance they'll cut 25 basis points. Like, does the Fed step in and do anything?
Yeah, well, there was a truth from Trump today that talked about energy prices are down, interest rates are down, inflation's down, even eggs are down 69%. And then he's asking Jerome Powell to cut rates, right? He said, hey, you need to consider cutting rates and stop playing politics. So, you know, a little bit of political jargon on there on the, you know, jawing back and forth on social media. But Trump really wants rates to be cut.
I mean, the Fed did ease without anybody knowing it. And here's how they did it. They reduced the amount that's going to run off the balance sheet every month. And when you do that, that means as stuff runs off, you actually, I mean, they're buying bonds to refill the coffers. So, and with that, they could actually do a little curve control too. I mean, they can be like, yeah, we'll buy some more 5 years, we'll buy some more 10 years, those types of things. So they quasi very stealthily eased. Not a lot of people paid attention to the balance sheet stuff. But I mean, look, at one point, I think they said, I mean, the Fed funds futures, and this tells you how this will change in a month, but I think it was like maybe a cut, and now it's 4. So, but that implies, remember, we've always talked about if the Fed is aggressively cutting, like you don't want that. That implies that something is wrong in the economy that they had to do that. So be careful what you wish for there.
Yeah.
All right. Let's talk about, I want to give a little perspective on, it goes back to the idea of, this is the worst, you know, all right. So some of the comments I've heard, is this the worst ever? Is this, you know, are we going to have a absolute crash from here? I'm like, no, nobody knows. That's one of the reasons why we hedge. Let me just go over a couple things that, I mean, if you think about, we had the global financial crisis in 2008, 2009. All right, the market took a little longer than normal to get back to old highs, but it made it. Black Monday in 1987. Well, market actually closed the year up, believe it or not. It was up a little bit. We had Vietnam War, oil shocks, you know, late 60s, early 70s, and then oil shocks 73 and 79, stagflation 73, 75. We had World War I, World War II, the Great Depression. The reason why I'm going through this, and then, you know, some other ones, Mike, like I've lived through the Asian contagion in 1998 when emerging markets was actually crashing and long-term capital management blew up. That's I think that's chronicled. Is that When Genius Failed? Is that the book that covered that? So
I'm
like
not
all
sure.
these things happen, and when in the moment it feels a lot heavier, and then you get perspective and you go away from it. And I think the worst thing that people can do right now is, and Jay always says this, Jay Pestricelli, you know, do you make a good decision when you're emotional? Have you ever made a good decision when you're panicking? And the answer is no. Like some of this is do nothing. Like if you needed the money tomorrow, that's something we would have worked out with people 6 months or a year ago. You know, that would have been planned for. So I kind of go back to that. I know it's hard sometimes for people to kind of take, a step back and not get too caught up, but this is sort of why you settle on a strategy and you stick to it.
Yeah, well, I would agree with you, right? And I've been in the market almost 20 years now, and it is always it is always a very similar story around staying in the markets. Don't make decisions irrationally, and your emotional behavior is important at this point in time, right? If you're working with somebody or if you're invested yourself, right, you just want to stay in, maybe make some adjustments. My theory is always stay invested, right? So trying to time markets is impossible, right? One of the great quotes, right, is it's time in the market, not timing the market. It's just too hard, right? Are we at the bottom today? Is it next week? Is it next month? Is it a year from now? We'll see. But irrational decisions are not the way to manage through this type of volatility.
So, Mike, you caught 2008, 2009, because if you're 20 years of market experience, that puts you, 2005 ish, right?
Yeah,
I mean,
that's right.
I guess. So you remember, so 2008, 2009, I mean, that must have been pretty shocking when you were kind of new to the business, and a couple of years in, you probably thought markets went up forever, right?
Well, yeah, after the 2008 crisis, right, markets really did only go up.
Oh yeah.
There was a few blips here and there. I think 2015, 2018 ended down around 4 or 5%. And then, 2020, even that pullback, the market rebounded very quickly. So the one thing I think that at least it always feels like it's the worst, right? So regardless of the downward market you're in, you're always thinking this is the worst one ever. But they do come back, right? So, and there's certain things that happen that you didn't see coming, right? And always I've always thought to myself later on after the pullbacks is I wish I bought more, right? That's always been my it's always what I've said to myself, years later or months later after these pullbacks. And, dropping today 2,200 points on a Friday, 10% in 2 days is a pretty significant move. And sure, it doesn't feel good, but this is overall okay for the market. And it's not anything we haven't been through before.
I feel like sometimes the quick drops are a little more shocking, but like 2000, 2001, 2002, think about this, Mike, the market went down 3 years in a row and the Nasdaq declined over 70%. Yeah. The .com,
Yeah.
And that was
that's a great point. Yeah. .com is a whole nother story compared to, 2008, 2022, 2018, all those pullbacks.
I also had sent you, so people are probably tired of hearing me say this, but the cupcake indicator, for anyone who's new, the cupcake indicator is when you turn on your local news, wherever it is, and they're baking cupcakes. In the bottom right-hand corner, they have a picture of the Dow. It's always the Dow, I don't know why, and Mike, I know we have an internal, Mike and I message back and forth during the day, and I took the picture. They were talking about like some new chocolate bar in the bottom right corner. That a lot of times that's a contrarian signal. Like if the normal news, who's baking cupcakes on the morning show, is showing you a chart of the Dow, and it could be early, but and the other one too is when CNBC does the markets in turmoil. That's the other one. I don't know if they've done that yet. I haven't paid attention. Have you seen if they've done that?
I haven't seen that one, but I have seen the CNN Fear and Greed Index, right? Which is usually whatever it tells you to do here is just do the opposite. And it is at extreme fear right now. So based on history, this would tell you to, back the truck up and load the boat and get into the market. That's not a recommendation. I'm just telling you what this index or what this indicator has provided.
Oh, it's at 4. It's 0 to 100. It's at a 4 right now. I just pulled it up. That's interesting.
Yeah, it's at a 4. I think that's the lowest I've seen it.
That is pretty low. So, all right. So the other thing I would just say is we touched on the high yield market. The high yield market is something I follow, and I look at the spreads. The spread between the yield to maturity on high yield bonds and the yield to maturity on a treasury. And that spread was very, very tight. It was very narrow. And it was, I mean, extremely narrow. It actually didn't widen until the last 2 days significantly. And the reason why that's something I follow and I really pay attention to it is the risk with high yield bonds is that there'll be outsized defaults. High yield is junk. It's companies, there's different ratings. So AAA bonds, or the likelihood of them paying back the people loan the money via bonds, pretty good. You get down into double Bs, triple Cs, those types of things, triple Bs. It's like, there's a reason why they're paying more to borrow money. So it started to crack, and I was actually interested. I thought the VIX wasn't high enough, and I didn't think the high yield bond spread had widened enough. We saw it today. So, I mean, maybe there's just a series of things that have to happen. Now, we know that sometimes Mondays are rough. When you have a bad Friday, a bad Thursday, it sort of continues on. So one of the things I'll be looking for, and you can tell me what you're sort of eyeing. I'm watching the high yield spread. I'm watching the VIX. I want to see, it closed at 45. That's pretty high. Sometimes when you get these really high spikes, like that's the crescendo. But I'd be watching Monday for, do we get a bad open? And that's the end of the weak hands. People who read the news over the weekends call their broker on, or I guess they don't call a broker anymore. They put in an order online. Like, that's kind of what I'm interested to see. Like that was today the last flush. Maybe Monday is the crescendo, and then, or it's not, or it could go lower. Like, I don't know. But I like, is that what you're watching for?
Yeah. We always talk about, clients who call in or advisors who call in, and if you're panicked, right. And it's kind of it's an odd indicator, because the more calls you get, the closer you are to the bottom. And I will say, like I think I said earlier, not a lot of calls yesterday, not a lot of calls this morning, but this afternoon there was quite a few calls. So, I'm not saying we're at the bottom, but I would say there are probably quite a few calls over the weekend as well. And that could be the tipping point, right? Where we say, all right, great. Everybody's called, everybody's panicked. And now we turn around and have a solid Monday, or a solid Monday afternoon, or, we bounce, Monday or Tuesday. So, I would say the panic in the air at this point, especially looking at this fear index on CNN at being a 4, which is almost as low as it can go, 1 or a 0 being the lowest. I think that's a significant sign that we're getting somewhere where we should find a support level.
I was just thinking of this too. How would you short this market? I don't mean like how you would structurally do it, obviously, but, and for anyone who doesn't know what shorting is, it's betting against the market. You make money when the market goes down, but just think about it. The market is probably one Trump announcement. I talked to President Xi. We're good. We're actually going to do no tariffs, and he's going to pay us,
right,
billions of dollars a year and drop all regulations. Like, the market just rockets on that news, right? I mean, like, that's what I'm saying. Like, even if you want to bet against them, and then, by the way, there's ways to do it with options and structured risk and defined risk and all that. But, being short right now has its own dangers. Like, this is very sensitive to a positive announcement. I mean, that could happen, right?
Sure, of course, right. One tweet, just one press conference, anything really. I think it's not going to happen, in the next day or so, and that's okay, right? There's deals going on, but I am encouraged that they're already talking about countries dropping tariffs. I mean, that could be the other thing, is countries just say, hey, look, we're going to drop all tariffs, just in wait for the U.S. to kind of drop theirs, right? So there's a lot of positives that could happen. It would be very difficult to short the market and feel comfortable.
There is some onshoring of manufacturing. TSMC in Arizona, they're building a big plant. I think they've even gotten some of Biden's infrastructure money or semiconductor, the CHIPS Act money. I think they're even expanding it. Some of this stuff would take a long time to bring back and onshore. But, I mean, I always look at, I think the thing that the pandemic did, though, they realized if you have 2,000 things to build your product and they're all from different countries, and then you have one country that this one little pin that you need for your product to finish it, and you can't get it. I mean, I think some of the onshoring was already happening post pandemic. It would take a while for it to really in earnest get back up. But I mean, definitely chips like TSMC is, I've driven by it. I know you have too when you've been out here in Arizona. Like that is a massive facility they're going to build out there.
Yeah. Yeah. So that's a good question though, right? In the talks with Trump around, bringing back manufacturing and plants and things like that could take a couple years, right? So is there a well thought out strategy there that Trump's thinking or the Trump administration's thinking around, we want to bring jobs back, or we want to build things in America, but that can take some time. So what's the solution there?
I mean, here's the good thing about our political system is, if you don't like the people who are in charge, next time you vote them out. The bad thing is that, really 4 years is pretty short because the first 2 years, then you have the midterms and usually whoever the sitting president is. And I think that's why, China plays a very long game. And I don't know how many presidents, President Xi has outlasted of U.S. presidents, but, Putin has been in for, going back to what? George W. Bush? Was he George H. Bush too? Decades. I mean, yeah. So sometimes these countries play the long game. But when any negotiation, and if you look at game theory and economics, is you look at who is playing the dominant game, who can endure the pain the longest. And I think that's going to be part of it. And I mean, I don't know. I don't think we can really, like in 6 months, I'll let you know. I mean, I usually joke around, but I think this is going to take time to tell if is this really working or not. And they seem pretty resolute that they don't care about what the market's doing right now. Like they're like, we got to do this. We'll see what happens.
Yeah. At this point in time. Yeah. They seem very much sticking to their guns here, which, is making some people nervous that it's not it's not going to turn around this weekend, but you never know, just like we talked about, right?
All right, Mike, I got a question for you. Market made an all-time high. What was it? 6,100, 6,200? Where was that? 6,200. What was it, Mike?
I think it was 61.47.
Okay, so people said, hey, I'd love to buy the market, but it's too expensive. Is 5,070? Are they buying here?
Yeah, absolutely. I think the market's on sale at this point, right? I think it's for them.
I mean, in theory, or do they say, well, I got to wait till it gets lower?
Yeah, I think waiting is a tough game. I like the market here. I think it's on sale. I think it's been on sale for about a week. It's really on sale now. There will come a time, right, where it's a screaming buy. I think there's a lot of good buys out there currently if you're a long-term investor. Yeah, so 61.47 was the high. We're currently trading at just above 5,000. So if you're thinking about getting in the market, pick your points, right? If the market hits a certain level, if you say, hey, look, if it hits 5,000, I'm buying. If it hits 4,900, I'm buying. Pick it and stick to your guns there. And also hedge or put guardrails on your portfolio. This is why we talk about this so much, right? When we had investors getting into the market at the all-time highs 2 months ago, we said, great, you want to get in the market. We think you should be in the market, but let's put some guardrails on your portfolio with some buffers or some downside hedging. So that's really important as well. If you're getting into the market now, we still think you should have some buffers or some downside hedging, right? If the market goes lower, you're going to want those hedges.
Yeah, I mean, and by the way, let me do a little live compliance for you, Mike. So what Mike is not Mike is not giving buy recommendations. He's
That's true.
he's just saying, we kind of try and give the bull and the bear case. But I think your point is like, look, if you were sort of waiting, you have a lower entry, and
Right.
you can buy. You can also buy, and you can at the same time hedge, so that if your timing stinks and it turns out, well, maybe it's going to go lower, you've got some sort of protection in there. But I go back to the, it's like you watch CNBC. I really don't watch CNBC that much anymore. But if you watch CNBC and everyone's like, well, I love the market, but I'm waiting till it's cheaper. It's like everyone was like, hey, in 2022, January, they're like, oh, I really like the market, but I want it cheaper. Great. Did you buy it when it was down 20%? No, I like the market, but I think I like it cheaper. Like there's always a reason not to buy. There's always a reason to sell. And, just stay hedged. One last thing too. I had a couple questions for these are people for, specific to a lot of advisors who use our strategies. And we don't get into the performance or anything like that because that's a whole other disclosure set. But just, we had some questions about, hey, I've got these hedges and the hedges are going up when the market's going down. And we've had questions about when do you take hedges off? Like when do you monetize? And I would just, tell people these are sort of the conversations internally that we have and we have it with our clients. But when we set hedges, a lot of times we say, look, I mean, you're hedged. It's doing what it's supposed to do. And, let the hedges work. Let them do their work. Let them cook for a while. That's as they say. So, all right, Mike, any recommendations this week? And you didn't give any, just to be clear, you gave no buy or sell recommendations, but I want if you had time to I know you were on a plane recently. Did you watch like a movie or did you watch like a show?
No. So I have a funny recommendation here of a book I started reading this morning. So if you haven't read this is going to be this will be my suggestion, which is I just started to read Trump's Art of the Deal. I know it's a little cliche, but after the announcement the other day, I thought to myself, let me just read his book and figure out what the heck is going through his mind. I would highly recommend just listening to the first few minutes of it if you've never read it before or opened it. And it immediately will give you an idea of what's going through Trump's head and how excited he is to be in this position. So I'm reading Trump's The Art of the Deal.
Doing a little
it's a research project. Yeah, a little research project.
I think, when did that come out? I feel like
Let's see, 1987 was the original version. They did a remake in 2016. That's what I'm listening to. And, kind of for the election kickoff there.
All right. I think I probably read that, but I'm trying to remember if we read it in like a business class or something. I
want to make sure this is not a political recommendation in any direction. Just like it's not a trading recommendation. This is just a book that I'm doing for a little bit of research purposes.
All right. And no movies or?
I haven't had time for movies.
Did you watch Society of the Snow? I know you didn't want to watch it because you were flying over the Andes in Chile, but.
No, I still haven't time to see that, but maybe this weekend.
All right. Society of the Snow is a good one. It's about the rugby team whose plane went down in I think it's the Andes Mountains in between, was it?
Yeah, in Chile. Yep.
Yeah. We have listeners, and that's actually when I look on Spotify, I think it's the 7th highest country listenership, believe it or not. So hello to our Chilean audience. We very much appreciate you tuning in. So I'm trying to think if I watched anything. Here's something that's on my list. Paradise. It's on Hulu. Jay told me about it, and he said it's really good. I have it on my list. I haven't watched it yet. So I got nothing, though. It's been a busy week. All right, Mike. I think we've solved all the world's problems.
All right.
Thanks, everyone. We'll talk to you next week. See ya.